Here's a number that should terrify you. If you wait just 10 years to start investing, you don't lose 10 years of growth. You can lose more than half of your total wealth at retirement. Not some of it. Over half. And the man who proved this isn't a mathematician. He's the richest investor alive, and he did it using a force so boring that most people ignore it completely. In 1963, Warren Buffett bought shares in a company for a few dollars each. He didn't sell when the price dipped. He didn't panic when the market turned. He just held on. Decades later, that single decision was worth billions. Not because he found a secret stock. Not because he timed the market. But because of one force Buffett himself has called the most powerful tool in investing. Compound interest. He said his wealth really comes down to three things. Living in America. Good genes. And compound interest. Two of those you can't control. The third one is just math, repeated, for a very long time. And that's the one anybody can use. So what is compound interest actually? Forget the textbook version you memorized for a test and forgot a week later. It's this simple. You earn interest not just on your original money, but on the interest that money already earned. That's the whole idea. Almost embarrassingly simple. But give it enough time, and this simple idea turns strange, then powerful, then almost unbelievable. Watch what happens. Invest $1,000 at 10% a year. After year 1, you have $1,100. Underwhelming. After year 2, you're not earning 10% on your original $1,000 anymore. You're earning it on $1,100. So now you have $1,210. Barely a difference. This is exactly the point where most people get bored and walk away. It's also exactly the point where Buffett didn't. Now skip ahead. Not 2 years. 40. That same $1,000, growing at 10% a year, becomes over $45,000. You put in $1,000. You walk away with 45 times that. You didn't work harder in year 40 than you did in year 1. You didn't get smarter. Time did the work. That's the entire secret. It was never hidden. Almost nobody has the patience to actually believe it. Here's what separates people who understand compounding from people who just know the definition. The growth isn't a straight line. It's a curve. And for a painfully long stretch, that curve looks flat. Boring. Pointless, even. Check your investment after 5 years against money sitting under your mattress, and the difference won't impress anyone. 10 years in, still nothing dramatic. This is the danger zone. This is exactly where most people quit, convinced it isn't working, right before it starts to. Because somewhere between year 20 and year 30, that flat curve stops being flat. It starts bending upward, then almost vertical. The money that was growing quietly in the background suddenly adds more in a single year than you originally invested in total. This is why Buffett wasn't a billionaire in his 30s, or even his 40s. Over 90% of his net worth was built after he turned 50. Read that again. 3 decades of successful investing happened before the real explosion even began. The first 30 years weren't the payoff. They were the setup. Think about what that means. If Buffett had retired at 40 to enjoy his money, you probably wouldn't know his name. He wouldn't be a symbol of wealth. He'd be a footnote, a moderately successful investor from Omaha. The gap between moderately successful and legendary wasn't a smarter strategy later in life. It was simply staying in the game long enough for the curve to finally bend. Buffett has his own way of explaining this. Picture a snowball at the top of a long hill, covered in fresh snow. At the top, it's small. You give it a push, and it picks up a thin layer. It grows just a little. Keep it rolling, and it keeps collecting more snow, but here's the part people miss. It doesn't collect the same amount every rotation. Because it's bigger now, it has more surface area, so it picks up snow faster than before. The growth feeds itself. By the time that snowball reaches the bottom of a long enough hill, it isn't a snowball anymore. It's an unstoppable force. And that hill, in Buffett's words, is a really long life. This exposes something most financial advice gets completely backwards. People obsess over finding the perfect investment, the highest return, the next big opportunity. But the length of the hill matters more than how steep any single push is. Someone who starts at 25 with modest, steady returns will usually end up richer than someone who starts at 45 chasing bigger ones. Not because they're smarter. Because they gave the snowball more hill. Let's make this concrete, because inspiration doesn't build wealth, understanding does. 2 people. The first starts investing $200 a month at age 25, earning 8% a year. They stop contributing entirely at 35. Just 10 years in the game, then they let it sit, untouched, until they're 65. The second person starts at 35, invests the same $200 a month at the same 8%, but never stops. 30 years of contributions instead of 10. Common sense says the person who contributed 3 times longer should end up with more. They don't. The first person, who invested for only 10 years but started a decade earlier, retires with more money. They put in far less total cash. They simply gave it more time. 10 early years beat 30 late ones. Sit with that, because it kills the excuse almost everyone uses. I'll start seriously once I have more money. Time in the market matters more than the size of your first check. So why doesn't everyone act on something this simple? Because compounding is emotionally unsatisfying in the short term, and we're not wired for delayed gratification. We want proof now, not in 20 years. A slow, steady line doesn't feel as good as a stock that doubles in a month. But here's the trade nobody mentions. Anything that can double in a month can also crash in a month. Compound interest doesn't work because it's exciting. It works because it isn't gambling. It's closer to gravity. Quiet. Invisible. Constant. And completely reliable if you let it run. This is also why Buffett has spent a lifetime avoiding unnecessary risk. Not because he's timid. Because he understood something most investors never grasp. If compounding is your engine, protecting it matters more than pushing it. That's the entire logic behind his most famous rule. Rule 1, never lose money. Rule 2, never forget Rule 1. It was never about fear. It's about protecting the snowball. A 40% loss doesn't just erase 40% of your gains, it demands a 66% gain just to break even again. Every major loss doesn't just cost you money. It costs you years of compounding you can never buy back. And that's the real lesson hiding inside the phrase power of compound interest. It was never really about interest rates or percentages. It's about protecting time itself. Every dollar lost to a bad decision, every year spent waiting, every panic sell during a downturn, isn't just a financial cost. It's measured in decades of growth that vanish with it. Buffett didn't get rich because he was the smartest stock picker who ever lived, even though he clearly is brilliant. He got rich because he was one of the most patient people to ever sit at a trading desk, protecting his capital, and letting 8 or 9 decades of compounding do exactly what compounding does. So here's the only question that actually matters. Not what stock to buy today. Not how to get rich fast. This. If 90% of Buffett's fortune came after he turned 50, after decades of slow, unremarkable, patient growth, what does that say about you, still waiting for the perfect moment to start? The snowball doesn't care about perfect moments. It only cares how long it's been rolling. The best time to start was years ago. The second best time is right now, before you close this video and go back to waiting for a moment that was never going to come.